Good morning, these dear clients, and welcome back in a new Flash Market video. Today, I have the great pleasure to welcome back Christoph HERBST from the asset management MainFirst, the German asset management. Thank you for being here, dear Jean-Christophe. First question, don't you worry about valuations? As you know, for several months, since November 23, the markets are very growing up. Isn't it the first sign of a bubble, according to you?
Yeah, we get that question quite often. What we have seen, basically, we had a strong concentration of performance. It was quite a few stocks that have driven global equity markets that have contributed a lot to that performance, especially the Magnificent Seven stocks. But overall, a bubble, in our view at least, looks much different. What we have seen right now, we have, for example, in the S&P 500, the largest equity market, equity index in the world, a lot of that performance came from those Magnificent Seven stocks. But the valuation of that names, especially in relative terms, that valuation have come down over the time frame. So when we're talking about the last 6 months, and the reason for that is obviously we have seen strong price increases, but what has risen even further is the profits those companies are generating. We have Microsoft, we have Amazon that are highly benefiting from the growth in the cloud sector. Then we have Tesla that actually went down with its valuation through a difficult time. Then we have Nvidia that's producing a ton of profits right now, a ton of cash, a ton of profits due to their sales in semiconductors, in GPUs. So from that perspective, overall, profits profits are justifying that increase in equity markets. Valuations on a relative basis have come down. And the second aspect we really want to highlight that sometimes give us a sign that maybe a bubble is being created or blowing up is the number of IPOs at stock markets. So, and this is what we definitely not have right now. Just after the financial crisis or the burst of the dot-com bubbles, we have seen such low numbers of IPOs that we are seeing today. And this is exactly the opposite. Investors are not hungry too much about risk. They are not over euphoric. So those 2 points make us very positive that there are no signs of a bubble being created. At the same time, we have inflation coming down a lot. Exactly the opposite should be the case. We should see an uptrend in valuation, especially in stocks that can grow organic revenue growth, that can show organic earnings growth. Because what we also see on a global basis, growth becomes rare and harder to find. And that should ultimately, in combination with lower interest rates, with lower inflation, benefit valuations. So from that perspective, no real signs of a bubble coming up.
So to resume, you stay very positive.
Overall, we can definitely say that. I mean, we are.
Yeah. Jean-Christophe, I know that you're quite invested in artificial intelligence. What's the potential of this topic for investor? And maybe the same then the first question, the valuations of this topic, of companies of this topic are really high. And isn't it too high? Is it still the moment to buy it or not?
Yeah, I mean, regarding artificial intelligence, the topic became really trendy over the last 2 years. Definitely, we can agree on that. But the biggest problem of the topic is at the same time its biggest chance, because artificial intelligence and the potential on several areas of businesses is broadly being underestimated. We can compare the situation we are in right now. If you imagine the grow up of AI over several industries, we are, and if you think about it in 10 steps, we are just in the first step or second step, basically. We combine that basically to the invention of the smartphone in the year 2007, highly underestimated by the public, the invention of the broader internet for the consumer in the early 2000s. We are in a different stage right now. And what we are basically seeing, just a number of hyperscalers, basically, of large cloud platforms are currently buying the hardware which is necessary for artificial intelligence. Those companies are investing here and there, but they are doing nothing else than research projects, basically. The technology of artificial intelligence has not reached the broad industry yet. Call centers, chatbots, medicine tech, self-driving cars, self-working and self-learning robots. All these areas need huge amount of computing power. They will use artificial intelligence. And one point we can definitely agree on today, what's quite sure, because history has shown us how that works. I mean, what we do with AI today is some of us use ChatGPT to type in text and words basically into the machine. We get back text and words, nothing else, nothing more. Mm-hmm. The next step will be pictures. The next step will be audio. The next step will be video, for example. And this is what we expect to get back from the machine. Mm-hmm. And each step we climb up that ladder, we have times 10, times 100, or times 1,000 multiplication of the amount of data that is being needed to calculate it, to saved, and to processed by the hardware. And I believe the most interesting area to be invested in for investors over the next 5 to 10 years to benefit from that trend of artificial intelligence being rolled out into the industry is the hardware side of GPUs, of semiconductors, regarding that AI trend.
And maybe a more general question. I know that your fund is quite performance, but as an investor, if I invest in your fund, what kind of risk, what kind of performance could I attend over 5 to 10 years?
Yeah, I mean, we're definitely not an MSCI World 2.0. Our target is to constantly and especially over the long run to outperform global equity markets. Obviously, we have a little bit higher volatility, but our long-term performance target that we are aiming is 15 to 20% per year on average for our global equities unconstrained fund. We are currently at 17.5%, so right in the middle of that target corridor, basically. But admittedly, the last 3 years had been tough. And we are happy that we can catch up with our performance now. And some of our major trends and projections that we have implemented in our strategy seem to fulfill now and seem to work out positively.
Okay, and to have just an idea, how many companies have you in your fund?
Yeah, we like a quite concentrated portfolio. Mm-hmm. We strongly believe that we ultimately want to create alpha against our benchmark, against the global equity market. We do not need too much diversification. Mm-hmm. So the optimum we are targeting is 30 to 35 stocks we usually hold in our portfolio. That's enough for diversification. The maximum position is usually 5%.
Okay. Thank you very much, Jean-Christoph, for being with us today, and see you soon. See you soon too, Jean-Christoph. And have a good day. Bye-bye.
Bye-bye.